In ye olden days, when an unelected monarchy found that they were running low on funds, there were limited ways to raise funds. Kings and queens didn't have the sophisticated accounting sorcery that we have today. One approach open to them was to plunder another kingdom and steal their loot. Of course, this came at great risk. It required raising an army and paying for it, and they weren't always guaranteed a successful campaign. Plundering came at the risk of being wiped out if things didn't go well. A second and safer approach was to levy taxes on their subjects. This required effort because the taxes needed to be collected somehow. Today, the kingdom known as the U.S. has the IRS and a means of collecting taxes before employees even receive their pay, also known as payroll deduction. Monarchs didn't have that, and the monarchs also risked being removed from office the hard way if their taxes were too onerous. Today's monarchs are generally removed in a more peaceful fashion. If taxation wasn't an option, monarchs of old could resort to seigniorage, which is a less obvious way of collecting taxes. Coins in the treasury could be clipped, made smaller, or adulterated with cheaper metals before being spent, and thus extend the life of treasury funds when spending levels were higher than tax revenue. Today, our seigniorage is a little bit more modern and consists of our central bank buying treasury bonds in exchange for freshly printed currency, but it's essentially the same thing. But if none of those options worked, the king or queen could simply borrow the funds that they needed, and if they couldn't find willing lenders within their kingdom, they would simply compel their nobles to quote-unquote lend them these funds. And I put lend here in quotes because the nobles would often be given very poor interest rates at best, and risked not being paid back at worst. Still, losing the money was seen as preferable to losing one's life. You're probably seeing that all of these techniques are still in use today. They may wear different clothes, but they're still in action. But you might think that in modern times our monarchs can't compel people to lend. In modern days, if lenders don't want to lend, interest rates will rise until a point is reached at which they do. Thus, our modern-day kings and queens need to be mindful of the bond market vigilantes, who can make life very difficult for an indebted nation by withholding needed funds until rewarded with the right interest rate. But you're missing something. Sir Alan Greenspan, yes, he was knighted, found a way to compel the subjects of the United States to quote-unquote lend to the monarchs. For those of you who don't have as many gray hairs as me, he was nominated to be the chair of the Federal Reserve in 1987 by President Ronald Reagan, and there he remained until January of the year 2006. Let's see how Sir Alan compelled the citizens of the United States to lend to the U.S. monarchs. Back in 1981, there were grumblings of the Social Security system no longer being solvent. Sound familiar? Sir Alan was an advisor to President Ronald Reagan and became chair of the National Commission on Social Security Reform in 1981. In 1983, the commission delivered its report, and in that year, the Social Security Reform Act was signed into law. There were many changes, but 4 of them were the most impactful. The first was to make Social Security payments to beneficiaries taxable. The next was to gradually shift the full retirement age for people born after 1937. Those who were 23 years or younger at the time would bear the brunt of this change, but they were too young to necessarily care enough to vote accordingly. The third was to increase the payroll tax, and the fourth was to change the way that the cost of living adjustments to Social Security benefits were applied. You can see the net effect of all these changes in this chart that I put together, and what I'm showing here is an extension of the charts that I placed in the prior 2 installments of this video series. It shows the borrowing of the U.S. federal government as a percentage of its spending from 1950 until today. In red is the borrowing most people see. It's the expansion in the public debt. And this is the debt we normally associate with willing buyers coming to market to trade their Federal Reserve notes for promises to pay back those Federal Reserve notes with interest. Of course, some of this is also seigniorage because some of the debt is monetized by the Federal Reserve. In blue is the accumulation of debt in what's known as the Social Security Trust Fund, which is really just a bunch of off-balance sheet government debt. It's just a bunch of IOUs. As illusory as the trust fund is, the spending, though, is very real. The government did spend all of the revenue that it received, and it replaced the balance between the FICA tax and the payments to recipients with non-negotiable IOUs that aren't even included in the public debt figures. Notice that before 1983, Social Security brought in about the same amount that it paid out on a year-to-year basis. In some years, there was a small surplus. In others, there was a small deficit. But in 1983, there was a big change. All of Sir Allen's recommended reforms resulted in a surge in revenue to the U.S. government. It was large enough, in fact, to enable President Bill Clinton to declare that the budget had been balanced in 1996, even though the U.S. was still accumulating off-balance sheet debt. But then we started seeing Sir Allen's magic start to dissipate in the mid-2000s, right around the time that he retired as the chair of the Federal Reserve. More benefits started to be paid out to retirees than were being collected in payroll taxes. The off-balance sheet IOU account started to shrink, but as we've already discussed, the spending was still very real. So the loss of ability to borrow for Social Security had to be replaced with more public borrowing. It didn't help that we had a large financial crisis in 2008 and 2009 that the government spent our way through via heavy borrowing. Good timing on your retirement, Sir Allen. Now, let's go back and amend one of my previous charts with this information. I'm about to show you all of the contributors to government spending since 1950, with the illusory effect of the Social Security Trust Fund removed. Here it is. On the bottom is the contribution of individual income taxes. Next is the contribution of all of the Social Security taxes that were actually paid out directly to Social Security recipients. I removed the effect of changes in the Social Security Trust Fund and placed that in the next category up, which is borrowing. So this next category includes both on-budget borrowing effects as well as the illusory off-budget borrowing effects. In my mind, borrowing is borrowing, and it doesn't matter which pocket you put the IOU in. The next category up is taxes collected from corporations, which are then spent. Then there are the excise taxes and other revenue that's spent. Government spending as a percent of U.S. gross domestic product has gradually increased from around 15 to 17% in the 1950s and 60s to around 22 to 24%, where it stayed pretty much since 1990. A large part of government spending has been due to an ever-increasing payment to the Social Security recipients. Now, don't let the fact that the red portion has been decreasing since the year 2000 fool you. The burden of the increased number of retirees to workers is still there, but it's being funded through borrowing rather than taxes. A few observations are in order here. First, the tax burden on corporations has fallen greatly since the 1950s. Next, while the tax burden on individuals seems to have stayed flat as a percent of GDP, it has been anything but. The payroll tax as a percent of GDP has grown, and the burden on the payroll tax falls largely on individuals. In addition, the debt has grown, and federal debt represents tax revenue that has yet to be collected. A final observation is that the government seems to be struggling to increase its spending beyond 25% of GDP, which makes sense. After all, a virus or bacterial infection that grows without bound eventually kills the host. Have we reached that limit? I think so. And now things bring me to the nudge. Remember this thing that I've been alluding to? This nudge that is required to upset the status quo and force our massive government to alter course? Well, that nudge is most likely to come from the ever-growing number of retirees per worker and the fact that the government has some very real obligations in front of it. Without taking some type of action, the past promises are likely to crowd out other spending. So what do you think, Sir Isaac? Sir Isaac has no doubt seen this play before. The characters have changed. For example, Sir Isaac has been replaced with Sir Allen, but the inevitable results of excessive promises remain the same. One solution is to take no action and continue to borrow to pay for current spending levels and cover increases in spending due to Social Security promises. Without central bank monetization, we'd see a repeat in the 1970s. Interest rates would increase as lenders became more and more disinterested. As interest rates increased, it would increase borrowing costs, not only of the government, but also of corporations. So stocks would sink as interest rates rose. And the increased rates would also cause the prices of existing bonds, as well as stock prices, to decline due to the discount mechanism. Gold would be seen as preferable as a safe haven. It would be just the 1970s all over again. Of course, the government could also try to contain interest rates via central bank debt monetization, and this would devalue the dollar at a faster pace and cause prices of everything to skyrocket. Chances are this would be an accompaniment for option number one. A third option is for a repeat of the 1983 Greenspan punt. The payroll tax could be increased again, and retirement ages for future retirees increased. The increased taxation and the perception that the system is fixed would cause the dollar to strengthen and would make bonds more attractive to bond investors. As a consequence, it would be a negative for the price of gold. And contrary to what happened in the 1980s and 90s, I would expect that stock prices would weaken. And this is because there would be less money available in the economy to spend due to excess taxation, and interest rates would be much lower now than they were at the beginning of the 1980s, not to mention that stocks right now are much more richly valued than they were at the beginning of the 1980s. Option 4 would be to increase the taxes on corporations. I can certainly see this as a possibility, given the very low level of corporate taxation now, and the anti-corporate sentiment that I've been seeing lately in a lot of locations. This would strengthen the dollar and be a benefit to bonds and weaken the gold price somewhat, but it would be a big negative for stocks. Not only would the spending power in the economy decline, but corporations would need to give up a bigger chunk of their profits to taxes. Option 5 would be to reduce government spending. Now, I really doubt that this is going to happen, but I'm listing it as an option. And again, in the unlikely event that the government reduces its spending, this would be good for the dollar and bonds, but bad for stocks and probably the price of gold. Now finally, we have the nuclear option, which is to reset the balance sheet entirely. I've talked about how the government could do this using the gold in the Treasury many times, so I won't rehash it here. But gold would go up by multiples relative to other assets. And the possibility and long-term inevitability of this option is the main reason to hold gold. So I've said it before, and I'll say it again. Gold, get you some. And maybe some short-term bonds just to cover your bases. I don't know what the near-term future for long-term bonds and stocks is, but I think the long-term future will not be kind to these financial assets.